Okay, so as I discussed in the last lecture, that this macroeconomics, we're gonna study three different things in this macroeconomics. The first is um, gross domestic product, or the national income, how we estimate the national income, in which we study three different types of things, which is a gross domestic product, gross national product, and per capita income. So gross domestic product is a consumption plus investment of the private firms plus government spending plus net export. So net export means export minus import. So this is the way to estimate the GDP. Then we look at the gross national product. So gross national product is GDP plus income from abroad, net income from abroad. So net income from abroad means if we are providing any services in a foreign countries, so whatever money we are making, subtracting if we are taking any services from any foreigner within a country. So this is called net foreign income. So this is your gross national product. And third thing is a per capita income. So per capita income is a total revenue divided by national income divided by total population. So this is the per capita income. So now we move on to the second part of macroeconomics, which is money. So in this money, we start with the meaning or definition of money. What is money? What is money? So, of course, money has a very general meaning. Money means something which is currency, and notes. Notes means paper currency made from paper, so notes. So currency and notes. Currency basically the coins and things, right? But economically, this is very simple meaning of money that we use it that meaning in our daily life. But obviously from economics point of view, it has a different meaning, right? From economics point of view, money means a medium of exchange. Medium of exchange, and measures of value. This is the meaning of money. Now, what is a medium of exchange? Medium of exchange means money is a medium. Money is a base that we use it to transfer information, transfer goods and services one person to another person. So medium of exchange means, so we are two people. So exchange of goods and services using a money, right? Using a money. That's the meaning of medium of exchange, right? So person A, person B. Person A is providing product or services to person B, and in exchange, person B is providing money to person A. So it's a medium of exchange. Without this one, how can you exchange the things? So in order to understand the medium of exchange, obviously, it's also a measure of value. Whatever product and services we are exchanging, we have to measure what is the value of that product. And obviously, the value of this product and service will be measured in form of money. Money is something that helps us to measure the value of anything. All right, obviously not emotion, relation, and things. So measure the value of something which is necessity, right? Especially foods and things, right? So that's the very basic definition of meaning, economics point of view, right? And daily life's point of view. Now, this economics, various economists, they define meaning in a various way. So they apply 4 different types of approaches to define the meaning of money, right? Approaches. So we have 5. We have 4 different approaches. The first approach is a conventional approach. Conventional approach. Under conventional approach, the meaning of money is a commodity. Commodities means items that we normally consume it in our daily lives, right? Or anything that we consume in our daily life, that's the meaning of commodity, right? So commodity is a medium of exchange. Is a medium of exchange. Medium of exchange and measure of value. Measure of value. So this is the conventional approach. Now, how can we commodity as a money? So the example, when we use the commodity to exchange goods and services, this is called a barter system. I think this barter system I explained you before. So barter system means, for example, rice and beans, right? This person has rice, this person has beans. So this person need beans. So this person will supply rice to this person. And in exchange, this person will supply beans to this person. This is called a conventional approach, a barter system, right? So this rice and beans are the medium of exchange, right? We are exchanging things by using rice or beans. Rice and beans, just example. It could be anything, not simply rice and beans. It could be fruits, right? It could be maybe animal. It could be exchange of animals. So it's not just simply this kind of rice and beans, anything. That could be exchange, like a pork with beef, yeah, chicken or fish, exchange it, right? So that's kind of things can be exchanged, or rice and the bread. Rice and bread could be exchanged, right? Coffee or maybe tea could be exchanged, right? Not just coffee and tea. It could be coffee and rice, coffee and green beans, right? So anything can be used to exchange. So this is called the conventional methods. Obviously, this method has various problems. One of the biggest problem is the unfair dealings, unfair value of 2 different commodities. So they don't have an equal value or the fair value, right? Or maybe some other reasons, like for example, it's very difficult to carry, right? You can't carry that kind of money in like, for example, if you want to carry $1,000, right? So you can easily put $1,000 in your pocket. But how about the 1,000, instead of $1,000, if $1,000 value equals to maybe 1,000 kilo rice, $1 1 kilo, for example. So how can you carry rice like 1,000 kilo? So it's very hard. So we will discuss these kinds of merit and demerit of this barter system later on. All right, but now we are discussing worldwide money divided into 4 different approaches. Right, time to time, money has been, the definition of money has been developed. Right, it's improved. Now move on to the second approach. Second approach is a Chicago approach. Chicago approach. According to Chicago approach, money defined as a time deposit. Time deposit. Time deposit define the meaning of money. So what could be example? Examples could be, for example, currency. Currency. Currency means paper or notes. So paper and notes are the money, right? Another examples could be a time deposit. Time deposit. Time deposit means you depositing money for a particular time period. Time change, value of money change. All right, so that's why money also have an association with the time deposit. Time change, value of money change. All right, so time deposit means the value of money associated with time. All right, for example, bank deposit. Bank deposit. You deposit $1,000 in bank now. After, let's say, 2 years. After 2 years, this $100 value will be increased. This $100 become 120, 150, 200. It depends upon the interest rate. But that's the meaning of time deposit. Right? So value of money has been changed. If the value of money has been changed, so means the definition of value, definition of defining the money also different. Right? So this is a Chicago approach. Third is a Gurley-Shaw approach. Gurley-Shaw approach. Remember, this Chicago approach and Gurley-Shaw, these are the people who define the meaning of money time to time. So that's why these approaches are use the name of these people. Right? Okay. According to this approach, money defined as a liquid asset. Money defined as liquid asset. What does it mean, liquid assets? Liquid asset means the assets which we can, which is liquid asset means which is equal to cash or easily convert into cash. Same like as your current assets. In fact, we call it quick assets, not the current asset. All right. So this is the meaning of money. So what could be example of money according to this Gurley-Shaw approach? So the best example is the savings. Saving in a bank is example of the money, right? Saving could be the people save money in a bank. It could be people pensions. Could be pensions, pension fund, any kinds of insurance reserves. These are the definition of meaning according to Gurley Shaw. So remember, the definition of money is as according to financial institutions, right? So according to these people, the definition of money is according to financial institution. Financial institution. Financial institution means, for example, bank. As per the bank, these are the meaning of money. All right. So this definition is not the money that we use it in for our economic system for trading purpose. Right? So it's especially for the financial system or financial institutions point of view, that this is the meaning of money. And the fourth one, the last one, approach. The fourth approach is a central bank approach. Central bank approach means money is recognized as realizable assets. Now, what does it mean, realizable assets? Realizable asset is the same like as liquid assets. We can say that it's a perfectly liquid or nearly liquid. Nearly liquid. Perfect. Okay, remember one thing. Liquid means cash. When we're using the word liquid all the time, liquid means cash. Something is in your hand that you can use it anytime when you need to make any kinds of payments. Yes, so that's the definition of bank, meaning according to central bank. In Vietnam, we don't call it central bank. In Vietnam, we call it state bank. State bank or central bank is any kinds of bank who control all the banks, and central bank is responsible to make flow of money in a country's economy. Right. So according to central bank, the money is something that is in liquid form, right? That is a liquid nature. If something is not in a liquid nature, that cannot be considered as a money. Why? Because if something is not in a form of liquid nature, you cannot use as a means of payment, all right? So illiquid assets, right? Or illiquid, or something is not liquid, something is not cash or non-cash. Illiquid cannot be used as a means of payment, right? So remember that something is illiquid. Illiquid means non-cash. Not literally non-cash. Illiquid means not imperfectly liquid, all right, or something cannot easily convert into cash without losing significant value. All right, you cannot convert into cash without significant losing value. For example, you have land and building. All right, can you convert land and building into cash? Yes, you can. But can you convert very quickly? Maybe yes. But if you want to convert your land very quickly into cash, you have to give a huge discount. Instant sell. If you want to sell your building or house overnight, it's difficult to find a buyer. So only buyer who has a less money. So it means if you are offering a huge discount to the buyer, then buyer will buy overnight very quickly. So what does it mean? It means we are reducing significant value of land and building if you want to sell right now, if you want to convert into assets right now, into cash right now. All right, so that's the meaning of that. That's why we say that fixed assets or illiquid assets we cannot easily convert into cash without significant losing its value. But for example, cash, perfectly cash, or nearly equals to the cash, which is maybe account receivable, you can convert into cash without losing its value. All right, because you have a right to receive it. So these are the different approaches has been applied to understand the meaning of approach. Any question or move on? Any question or move on? Say something. Can we move on? So let's move. Next is a function of money. Function of money. Right. Money has 3 different functions. But in a simple language, money, generally money academically, if you have a look, money divided into 3 different functions: primary function, secondary function, and contingent function. But in very general way, we can define function of money in various way. So money has a various functions. What functions money has? It's a medium. It's a medium. All right. Without this one, you cannot exchange goods and services. That's why we call it. It's a medium, right? It's a way to transferring things one to another, right? Second one, a measure. It's a way to measure the things that we're gonna exchange. All right, or that we wanna buy or we wanna sell. So money helps us to measure the value of commodity that we may be acquiring or we are supplying. Third is money is something which is a standard. Which is standard, which is fixed. Not literally meaning fixed is never change. Obviously, there is an inflation in the market, but the value of money is a standardized. Standardized means it's basically controlled by the regulatory body. So that regulatory body called a central bank, which determine the value of money, right? So that's why money is something which value is quite quite reliable, we can say that. All right, widely accepted. Whatever value is decided by the central bank, that value is widely accepted. You cannot say that, oh, this $5, I don't consider it as a $5. In my opinion, it's a $6, or in my opinion, it's a $4. That's normally problem we used to have with the gold coins. Some people start when the government, when they started using gold coins as a medium of exchange, so people start clipping the coins. They start cutting the coins. So means like one coin like this, another coin is smaller than this coin. All right. So that's the problem started occurring using the gold coins or any kinds of kind of expensive metal coins. Right. But if you look at the examples nowadays, we don't have that kind of problem. Right. Of course, we have a problem of fake currency. That's a different story. But generally, currency is a regulated or standardized. And another functions of money could be a store. You can store it. You can keep it. You can save it, as people normally do. Maybe keep at home, save at home, or they put money in banks. All right. But if you take example of the commodities, like for example, you can save $100,000 in your bank, right? But you cannot save rice which value is $100,000 at home or in a store department. You require lots of care for that $100,000 value rice. All right. So 100,000 means, for example, if one rice is $1, it's not $1. It's, I think one rice is let's say $1, good quality rice. All right. So one rice is $1, so which means 100,000 kilo rice. You have to store it. All right. But in order to store $100,000 that you can keep it at home, but you don't want, but you can still store in a bank. So it's ESO. So that's the function of money. So it can be stored. All right. The value of money can be stored, but product and services cannot be stored. All right. For example, I wanna, let's say I'm your teacher. I'm teaching you this economics. I need a food, and you have food, right? So I said that, can I have food? And you will say that, yes, we can give you food, but you have to exchange something. I said, okay, I can teach you one lecture for economics or accounting, right? So I am giving you service, which is education. And in exchange of service, you are giving me food. You're giving me rice, you're giving me beans or coffee or whatever, right? So means I'm giving you knowledge, you cannot store it. All right. Even maybe I can store you the food that you are giving to me, but something that I'm exchanging with you, which is service, you cannot store it. You cannot store it in advance. I can't give you education or knowledge in advance. All right. Or you cannot test the knowledge in advance, but I can test your food. So this is the normally problems, but that's problems we don't have when we have a money. All right. So these are the basic definition of basic functions of money. All right. So let's discuss about function of money that I explained. Economically is divided into three different parts: primary functions, secondary functions, and contingent function. So as I explained you before, function of money divided into four parts. All right. So we have, in general way, there are four different types of function of money, which is a medium, a measure, a standard, and a store. All right. So now it divided into, so these four divided into two parts in order to understand the three different functions. So one, 2 and 3. We have three different functions that we're going to study here. So the first is we call it primary and main function. This is primary and main function. Primary, what is a primary function of money? Obviously, medium of exchange, and there's something it can be measured. So that's the primary functions. Secondary function is it must be standardized and it must be stored. So this is secondary and subsidiary function. Subsidiary function. So this is the first function. This is the second function. So these two functions I already described before. Now the third function is a contingent function. Third function is a contingent function. So what are the contingent function? Contingent function, the first thing is a basis of credit creations. Basis of credit creations. Basis of credit creation means increase the value of your credit, increase the value of your existing money. That's mainly the function of money. Why we need money? Obviously, we need money for daily lives, right? We need money for, like, for example, from my point of view, why I need money? I need money to live, right? Why I need money to live? Because I will eat money? No, I will use that money to acquire product and service. So from another person point of view, money to make money, right? Because one person need money to make money, and another person need money to have food. All right, so means they will ask for food, and this person supply food and take money. All right, so the idea is that's the function of money. Is the function of money, the basis of credit creations. All right, so that's mainly the purpose of money. That's why we require money. Second one is a maximum satisfaction. Maximum satisfaction. The main function of money is to satisfy people by saving money, by making money to secure themselves, right, for future, to avoid any kinds of uncertain risk in the future. So that's why people start saving or making money, right? So it's providing them kind of satisfaction. To satisfy that, we can avoid any kinds of unexpected financial difficulties, right? So that's the reason we require money. Another function of money is a distribution of national income. Distribution of national income. Distribution of national income, so means we use national income to estimate the per capita income, right? So how can we distribute it? So that's also the meaning of per capita income, distribute the national incomes among the populations, right? So that's called and again, that's another function of money, to spread out the money. So these are the mainly contingent function related to money. So the idea is that money divided into three different primary functions, secondary, and contingent function. Contingent function is more about more economically, more maybe micro and macro economics. It could be individuals, could be involved in credit creations, could be firms in credit creations, right? Household involved in a maximum satisfactions, right? And finally, government, which is macroeconomics, involved in a distribution of national income. Right? So these are the functions we have. Right? So function of money is finished. So let's move on to the next. Any question? Any question, or we move on? Move on. Next is money concepts, or the concept of money. Concepts of money. All right. The concept of money is coming from really long time, right? Money has been using for many, many years, thousands of years, I mean, we can say that. But the concept of money is changing, or the definition of money is changing, or the form of money is changing. All right. But money, what has been using from many years. All right. Not literally money, they maybe call it medium of exchange, or they may call it means of payment, right? But it has been using for many years, right? I mean, nothing was free. It's all about give and take, all right? So if something you want to take it, you have to give something. So that's called the medium of, that's called the means of payment. So you require something to pay off, right? So, so let's have a look about concept of money. With the help of concept of money, we will understand the evolution of money, money evolutions. So concept of money help us to understand the evolution of money. Evolution of money. So the first is a barter system that we discussed before. So we're going to discuss all these things one by one. So first is a barter system. Instead of saying barter system, we can also call it commodity money. Commodity money. Commodity money means people use commodities or animals as money. That's called commodities money. All right. Okay. But of course, as I mentioned before, this commodity money or barter system has some kinds of disadvantages or demerits. Disadvantages or some kinds of demerits we have. First is commodities are not homogeneous. They are not same. All right. So if the products are not same, so the replacing product could be unfair for being maybe for buyer or for seller. Right? So it's very hard to determine that how many rice must be supplied in exchange of beans. Right? So they have to be standardized, but that wasn't really things happen under this commodities money. So again, that because commodities are not homogeneous, so there could be issues of exchanging things. Right? Second thing is a supply of commodities may change. Supply of commodities may change. Supply of commodity may change means, for example, in one village, people are growing the various kinds of crops, right, to consume or to exchange. But due to some reasons, their crops has been destroyed. So now what options they have left to exchange the things? Everybody's holding a meat. So they don't have much options to get the variety of food because all having the same kinds of commodity, right? So means if the supply of commodities are affected, so maybe your exchange activities may be affected. All right, your exchange activity may be affected. So that's the reason the problems we occur when we have the commodities things, right? Third is hoarding, not possible. Not possible. Hoarding means storage. You cannot store it. That's we discussed before. It has a problem of storage, right? So you cannot store the large quantity of rice, beans, or meats, right? So, but money that you can use it. Number 4 is a lack of portability. Lack of portability means it's not portable. It's not movable easily. As I give example before, carrying a $1,000 or 1,000 kilo rice, so hard, right? Carrying a 1,000 kilo rice, right? So in fact, it's impossible for one person. If you take the example of the average person, all right. So this is the problems we used to have when we have a commodities money. Now, after commodity money, as we are discussing what evolutions, so it's improved. So the barter system removed, right? So after commodities money era, new era come. So this is metallic money. Metallic money. All right. So metallic money means something, any kinds of money instead of commodities could be used, which is in form of metal. All right. So initially it was gold, silver, maybe brass, copper, aluminium, maybe steel, so on, etc. Right? These are metallic money. Initially it was gold and silver, right? But because of Gresham law, yes, Gresham law. Gresham law. According to Gresham law, expensive metal should be out from circulation system. That's the meaning of Gresham law, which means if any kinds of metal which is expensive, that must be out from circulation system, means that metal cannot be used as a means of payment or medium of exchange. Why we have to take it out from the circulation system? Because of the availabilities. So these gold and silvers considered as a scarce resources, right? Limited resources. Due to the limitations of the supply of gold and silver, it must be removed from the circulation system. In comparison, I think gold, silver, and brass. Right? So these kinds of metals considered as expensive metal compared to the copper, aluminums, and steel. Right? So these copper and aluminum steels are easy productions or large availability. Of course, these also come from the nature, but compared to the gold and silver, these are less expensive. So the idea is that according to Gresham law, least expensive metal will be used to circulate, right? And expensive metal must be out from the circulation system. So we cannot use expensive metal. As I give example, first reason is, of course, it's come from the nature. The supply of these expensive metals are limited. That's why we call them expensive, because availabilities are too less, right? Second reason that I also gave you before, that this gold and silver, the value wasn't standardized for the gold coins because it's made by the people, right? So the shapes of the gold coins may be different from the gold coin you are holding. The gold coin I am holding, shape may not be exactly, because obviously shape at that time made by hands, made by the people. There wasn't any machine, so who can perfectly shape the every kinds of gold coins. And another reason was gold was so pure, so people can easily clip and cut the golds to, like, for example, I have a 15 gold coins, and in this 15 gold coins I cut very small all these 15 gold coins. From this 15 gold coins, I make it 17 gold coins. All right, reduce a little bit size. So that was the problem with this kind of expensive metals. All right, it were not standardized, and of course, that's issues. So in order to remove that kind of problems, they convert these kinds of most expensive metals, currencies, into least expensive metal. So these are most expensive, least expensive. Least expensive. Least expensive metal. That's the meaning of, that's the purpose of the Gresham law. All right. Now we have a look some demerits of this metallic money. Demerits. So what are the demerits of this? First is too heavy. Right? It's heavy. It's not easy to carry these kind of coins and metals. Right? Second thing is depreciation. This depreciation is not exactly the depreciation we looked in accounting. Here the depreciation means if you continuously using the coins start getting old, right? So value of coins are going down if coins are getting old, right? So that's also the problem of these kinds of, I think, if you want to renew that coin, it's required lots of cost associated. Okay. So too heavy, depreciation, and second, another reason is not adjusted to their demands. That was another problem. The production of these kinds of coins were not equal to the demand of the coins in the market. As a result, people not having a everybody's not having a coins, or everybody's not using a coin to exchange the commodity. So at that time, we also seen that in the cities or in the urban areas, people started using coins to exchange goods and services. However, in rural areas, people still started using gold coins or maybe commodities to exchange goods and services. Right. So that was the issues that we had related to this metallic money. Then the third, so it's improved from metallic money to, obviously, it's a paper money, paper currency or notes. So paper money, obviously, paper money issued by central bank or state bank, depends. You can call state bank if you want, central or state bank. All right. Initially, so let me explain to you something very interesting thing. Traditionally, different countries, they started using paper currency. For example, UK, US, Australia, and maybe, I don't know, maybe Vietnam, right? Traditional. UK, they have their own notes. So every country has a paper currency, right? Paper currency. Paper currency. So obviously, the paper currency of UK is different than paper currency of US. And obviously, US different. So all these countries' paper currencies are different from each other. All right, so means if you are holding a UK paper currencies, which is UK pounds, we call them pounds, all right, GBP, all right, and USD, and AUD, and BND, all right. So these are the paper currencies of their country. I'm not talking about right now, I'm talking about traditionally what used to happen. So you live in UK, right? Now you are traveling to US for business purpose, export, import. So of course you require USD. So what you used to do, you buy gold. So you buy gold in England, right? And then you carry this gold to US. And then you convert gold into USD. And then you can conduct your business in US. You do business, you make money in USD. Now you want to go back to your country. So you convert USD into gold. USD into gold. And then you bring gold to England. And then you convert gold into pounds. All right. So traditionally, they use gold as a foreign exchange. All right. it's basically the yes, foreign exchange system used to happen on the basis of gold. But there was a problem here. The problem was the country which has a less production of gold. Let's say in US, gold production is less. US has a less gold production, and in UK has a high gold production. High gold production. So means you are richer than the US. Your economy more strong than the US, because gold is the base to measure the value of currency, right? So whoever has a more gold considered as a more economically strong, better purchasing power. All right. So it's really good for Americans who will go to England to buy gold. All right. Because obviously in England, the supply of gold is high. So value of gold is lower than the value of gold in US. But when England, they will bring that gold to US, the value is high. So that's why England people, they convert their pound into gold, and then they bring that gold to US, and then they do business. So it means they have more money, they are more economically strong in US. This is my example. I'm not saying that UK has a better gold production than America. I'm just giving you example so that gold has an unfair system, right? And especially like, for example, if you take any country like as Vietnam, for example, they are not producing any gold at all. So means they are economically not very strong compared to the country which is producing high gold, right? So this is the problem we used to have under this gold issues, right? But now this problem has been removed. All right. So there is you not require, if you have a grid, if you have pounds and you want to convert into USD, now you can directly convert it without using a gold as a base. You know that this is called foreign exchange. Same thing if you have Vietnam dong, you want to convert into Australian dollars, you can directly convert into Australian dollar. You don't have to buy any expensive metal to convert your Vietnam dong into Australian dollar, right? So that was the interesting thing. It used to happen before. So that was one of the reason, I think, after World War, let me think. After World War I, before World War I, some European countries, they used to be economically strong in terms of holding golds and things. But later on, after World War I, so Americans, they have Bretton Woods agreements or some other kinds of international monetary funds. I hope you heard that. If you don't know, so don't worry. And later on, it's started improving. They start avoiding gold as a base. As I said, after World War II, there was a lack of countries' economic situation has been changed drastically. Some maybe store too much gold, some they do not store too much gold. So some countries, they stop connecting their currencies with gold. All right. So at that time, whoever is a stronger countries in the world, from economic point of view, they use that current currency as a base. So I think US and after World War II, US become the major. But before it was a pound, British pound. Before Second World War, until Second World War, it was a British pound. But after World War II, USD become a stronger currency, or it's become a common currency. That means the base that we can use it to make any kinds of transactions. So that's why sometimes you see that any kinds of country currencies in the world, we always compare that currency value with USD, not with the gold, for trading in a trading sense. All right. So like, what is the value of $1, $1 USD in Vietnam? All right. So something like this. All right. So all the countries, so whenever you see the foreign exchange rate, they always use the USD as the base. Before, they didn't use USD as a base, they used the gold as a base, right? So um, um, one gold equals to how many, 1 gram gold equals to how many Vietnam dong, 1 gram gold equals to how many USD, 1 gram gold equals to how many British pounds, something like this, right? But now it's different. So nowadays, whatever system we have, we call them flexible exchange rate regimes, all right? So means exchange rates become flexible. It's not a fixed like as gold. It was a fixed, right? The value will not be fluctuated, all right? But now we have a flexible change, right? Exchange rate value of currency change, right? So these are the paper currency. So now have a look at some demerits of the paper currency. So obviously we have a major demerit is inflation. Inflation means supply of money increase, right? Inflation means supply of money increase. So in order to control the supply of money, we have a central bank or state bank, all right? So that's why issued by central or state bank, so they can control over the supply of money, all right? They keep supplying. So obviously demand and supply, we call it monetary policy. Monetary policy. Under monetary policy, state bank or central bank decide the interest rate. They decide the interest rate. If they wanna reduce the supply, they increase the interest rate. Interest rate means interest rate of lending, bank lending. So if bank want to minimize the supply of money, what bank will do? Bank will not stop supplying money. You can't say that you go to bank say, no, we cannot supply you money because central bank asked us not to supply money. No, they're not going to do in such way. So what central bank will tell the banks? Central bank will strictly tell the bank to increase the interest. So the banks will increase the interest lending rate. So all the banks will increase the interest rate. So when you go to bank to borrow money, bank gonna charge very high interest, and you worry. You're not gonna borrow money from bank with a high rate of interest, because how are you gonna return that money back to bank? All right. So that's why, in order to control the supply of money, bank will increase the interest rate. All right. And then supply of money has been stopped. No more supply. And then people start consuming, circulating that money. All right. And whenever investment opportunity arise in the money, in a market, as I explained you before, these kinds of investment firms, manufacturing firms, or any kinds of primary or secondary, especially secondary sectors. So this kind of secondary sector require funding, so they can maximize their manufacturing, because consumers are demanding for the product, so they require fund, right? So they require fund, they will go to bank. But central bank, they know very well. Central bank is remember, central bank is tracking everything. The GDPs, the consumptions, the government spendings, and the private company involvements, and all these kind of things. Banks are tracking and looking everything, monitoring all the kinds of financial, transactional financial activity of that country. So that's why bank can decide it's time to supply money or it's time to stop supplying money. If bank not regulating or bank not supervising the country financial system, how can bank understand it's time to supply or not? So when bank decision is wrong to supply money, it can collapse the economy. That's what normally happen, like in Venezuela or some other kinds of their regulatory system, their demand supply money system is not so well organized by the central bank. As a result, the economy could be collapsed. Interest rate, inflation, right? So interest rate increase, supply of money will decrease. So when investment opportunity arise in a market, central bank will open supply of money, because people start demand right? So what central bank will do? So they will, banks start announcing, we are reducing interest rate. If you want to borrow money, so come and borrow. So all the industries, maybe household, or maybe individuals or firms, investors, they will go to bank to borrow money. All right. So supply of money will increase, and then stop, open, stop, open, stop. So this is the basically the system happen in order to look at the country economic system. I mean, supply of money things. All right. So this kind of increasing or decreasing interest rate comes under monetary policy, and that monetary policy issued by central bank or state bank, you can say that. All right. So these are the things happen. So you can, yes, that's one of the disadvantage of paper money is inflation. But obviously we can plan better to control over the inflation by supervising or looking economy in a right way. Right. These are the things we have. Right. So this is the paper money. So paper money is finished, right? And after paper money, we have some other kinds of money that has been also has also been used, such as online transactions. But obviously, online transaction is your virtual money. I think we call it virtual money, right? All right. So that's mainly your online or any kinds of things. Online transfer is not the money. It's basically the okay. So as I explained, we have a virtual money. That could be any kinds of money that could be used, like as online. Online system is not the money. Actually, online system is a method of payments. All right. This could be online. This could be checks. This could be credit cards. They are just a method of payments. All right. So obviously, you're keeping money in a bank. So these are the concepts of money. So let's move on to the check. Let's move on to the last part of money, which is factor affecting the demand for money, as I explained you before. So factor affecting the demand for money. Factor affecting the demand for money. So let me draw a graph here. So as I explained before, that when people start demanding money, then central bank open the supply of money. All right. But we need to understand why people demand for money. What are the reasons that people demand for money? So that's why we have to understand which factors encourage people to demand for money. So there are three different factors that people demand for money. All right. So the first factor is a transaction purpose, transaction motive. Second one is a precautionary motive. And third one is a speculative motive. So people have a three different purpose: for transaction purpose, for precautionary purpose, and for speculative purpose. In simple language, transaction purpose means we need money to buy things for necessity. items. We need money, food and things, right? So this is called transaction purpose. Second one is a precautionary purpose. Precautionary purpose means saving, save. People need money to save it for future unexpected economic events, right? Second is a precautionary purpose. Third one is a speculative purpose. In simple language, investment purpose, all right? So people demand three different factors that people demand for money, right? People need money, right? That money may come from making, go to work and generate that money, right? Or that money could be borrowed from bank, right? That's not the matter how people get money. The matter is why people need money, right? So three different motive. So first motive is a transaction motive. Transaction motive, right? So transaction motive means people require money for daily activities. So purpose of transaction motive is a consumption, all right? So that's the purpose of this transaction motive. People require money for consumption purpose. We need things, right? And remember one thing, if country GDP increase, this transaction motive also increase, obviously, because under GDP we have C plus I plus G plus X minus M. C is a consumption, right? People are demanding. Why people are demanding? Because people have money. They require things, they require items, they have a source of income, right? So they require money. That, as I said, they require money. That money could come from working, employments, or that money come from inflow of money through the banks, right? So people demand for money through the transaction purpose, right? So that's why if GDP increase, your transaction motive also improve. Right? Second one is a precautionary motive. Second one is that precautionary motive. What are the precautionary motive? Precautionary motive means people save money or need money for, people need money for their unexpected expense. Precautionary motive means people need money for unexpected expense. Unexpected expense. All right. That unexpected expense could be any kinds of bills. The bills for health, bills for education, bill for house, or any kinds of things that you require immediate payments, right? So when you need money in any kinds of emergency, this is called precautionary motive, right? You need money to meet your unexpected expense, all right? So that's called the precautionary motive. Third one. Third one is the speculative motive. Speculative motive. Speculative motive purpose is to store value, store of value, stores of value. And this store of value normally depends upon your rate of return. Rate of return. What is rate of return? Rate of return means any kinds of return we earn it on our investment. Let's say, for example, if you want to deposit money in bank, $10,000, you go to bank to deposit money and you ask bank, how many percent rate of interest I will earn if I keep that $10,000 in your bank for 1 year. And let's say bank says that we will offer you maybe 6%. All right. So 6% is the rate of return. All right. So means you are storing the money, right? You are investing, saving, mainly investing, right? Not really saving, because saving could be precautionary motive. So you are investing money, right? You are speculating it. Speculating means the real meaning of speculative or speculation is that when you do something, but you don't know why, you don't know the reason behind it. For example, gamble is merely speculations, right? So you don't know that what's going to happen next, right? So again, so in this speculative motive, you're going to put money in investment. You are not 100% sure that your investment will go up, no matter what kind of method of instrument you choose it, or financial instrument you choose it to save money. So for example, before coronavirus, economic was like, many countries' economic was going well. People started investing money in various sectors, right? But when pandemic arise, then people lose their investment, lose their interest, lose their income, right? So that's why we call it speculative motive. We are not sure what exactly happened in near or longer future. We are not 100% sure about it, right? Okay. 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 Now, remember one thing, speculative motive is like investing related, right? It's kind of speculative motive have a relation with investing. And remember one thing, when people think holding money more riskier than investing money, then people demand for money for speculative purpose, all right? When people think holding money more riskier than investing money, then people demand for speculative motive. Let me give example. For example, you have $1,000, right? You wanna save or invest, or you have this $1,000. The purpose of this is not $1,000 has a relation with precautionary motive or transaction motive. It's extra money you have. Either you keep it or you invest it, but it doesn't have any specific purpose, which is transaction motive or precautionary motive. All right. So now you have three options. You have three different options. One option is you keep this $100 at home. You keep this $1,000 at home. Second, you keep this $1,000 in a bank, all right? And bank, for example, is giving you 6% rate of interest, all right? Third option is that you spend this $1,000 in stocks. And stocks, for example, stocks rate of return, let's say blue chip stocks, good stocks, right? Like for example, Vingroup in Vietnam, stock is quite stable stock to invest it. So let's say stock rate of return or earning per share for stock is, let's say, 30% return. For example, now you have three options, A, B, and C, all right? So, and we assume there is a 2.5% inflation in market. 2.5% inflation in market. Now remember that if you keep that money at home, $1,000, if you keep money at home, your money value reduced by 2.5%. People think that my money is safe. My money is not reducing. Nobody's stealing my money. I lock, maybe you dig the land and you put in money in the land and you cover it with sand and you put something heavy stone on this. Oh, my money is safe. Nobody's taking money out from me. It's not safe. In fact, this $1,000 value is reducing by 2.5% every year. If let's say inflation rate is 2.5% every year, with your first option. Second, B option, bank, your money increase by 6%, right? And decrease by 2.5%. So means your money net increase by 3.5%. That's your net increase, not 6%. Net increase is 3.5%. But if you look at the bank, wow, bank is giving 6% interest rate. So why don't I invest in a bank? Because my money will increase by 6%. No, your money will not increase by 6%. In fact, your money increased by only 3.5% because 2.5 decreased by inflation. All right, 2.5% decreased by inflation. All right. Third one is a stock. Inflation is 2.5%, right? So you can minus 2.5% from here. So which is 27.5%, right? So your money will increase by 27.5%. But again, stocks are riskier. Stocks are riskier than the other two investment, but stocks giving you better return. So that's why in investing or in finance, we always say that high risk, high return. High risk, high return. If you want to get a high return, you have to take a high risk. Otherwise, just be satisfied with your 3.5%. So it's up to you. You want to make 3.5%? Or you want to make 27.5%. Generally, the investor nature is a risk averse. Generally, investors do not like to take a risk. But of course, there are some other risk taker too. But on an average, if you look at investors, they don't like to take risk. So I'm not saying that nobody invests money in stock market. Of course, before they taking any kinds of investment decision in stock market, they have to study the stocks. They have to understand the movement of the stocks, or maybe some other kinds of economic, political factors also affect the movement of the stocks, all right? So these kinds of activity belongs to the speculative motive, all right? So that's normally happen under speculative motive. Right? So under speculative motive, your forecasting is really important. All right. So your forecasting play a very important role. When you are involved in any kinds of speculative, you have to be really, really long-term sights. You have to keep it. Right? You have to know that what's going to happen in near future or in a longer future, in a longer run. So it's very important. All right. So interest rates very important. So always remember, if there is a high interest rate in a market, so it means if there is a high inflation in a market, people less money demand for speculative motive. Speculative motive has a direct relation with the rate of return, is directly affect from rate of return. If there is a high inflation in a market, your rate of return will be reduced, as you can see here. If inflation become 4, your rate of return will be only just 2. All right. So if there is a high inflation in a market, high inflation means high rate of return. High interest rate, lending rate. High interest rate. Interest rate means when you borrow from bank, loan. Is borrowing or borrow from bank. If interest rate is high, your inflation is high. Obviously, inflation is high, your rate of return will be low. If your rate of return will be low, you have a no speculative motive. Speculative motive is an investment motive, making money, investing money. And why you want to invest money? Because you want to make your money increased. But again, you are risk averse. You don't like to take a risk too. So that's why you will not demand for money for speculative motive if there is a high inflation in a market. Right? High inflation in a market. So you're not looking for investment opportunities. That's why when there is a high inflation in a market, there is a less probabilities that country economy will grow. Right? Because people have no investment motive. There's no any investment intention. People have no investment purpose, right? But there is a one good point of inflation. Inflation is not always bad. One good point of inflation is that inflation may attract foreign investors. All right. For example, if the value of Vietnam dong is reducing, what does it mean value of Vietnam dong is reducing? It means value of USD is increasing, because USD is a base to measure the value of Vietnam dong. All right. So when say Vietnam dong value reduce, what does it mean Vietnam dong value reduce? Vietnam dong value reduce means Vietnam dong we are comparing with USD. If USD is getting stronger, Vietnam dong is getting weaker. So means Vietnam dong value reducing. All right. So reason could be inflation, maybe some other reasons. All right. So, but one a good point of inflation is that when Vietnam dong value will reduce, it may attract foreign investors. That's why some countries, they reduce their currency value purposely. That's what happened in 1996 in Thailand. So Thai government, they reduced their currency value purposely. So Thai baht, I think currency is a Thai baht, BHAT, I guess. Thai baht, I don't know how to pronounce. Thai currency value reduced, right? The government reduced, Central Bank of Thailand, they reduced purposely. But again, it has some negative consequences, economic crash. But that's a different story. But the idea is that some countries, they reduce their value of money purposely because they want to attract foreign investors. Because if foreign investor, they invest, it is cheaper to invest, let's say Vietnam dong. If the Vietnamese government, they reduce the value of Vietnam dong, foreign investor will jump in Vietnam market to inject their capital to invest, right? So it may boost the country economy. because many foreign investors are investing. So it will provide lots of job opportunities to the locals, which is again secondary sector start improving because they need a fund. Government is not supplying fund because supply of money, government stops supplying money. So foreign investors, they come and they supply. So means they are demand for Vietnam dong, because when any foreigners, they want to invest money in Vietnam, let's say American are investing money in Vietnam, American bring with USD, so they have to buy Vietnam dong. So they start demand for Vietnam dong. Vietnam dong demand, so Vietnam dong start improving again. Vietnam dong is improving because foreign investments are coming. All right, so that's also kind of purpose for companies to countries to reduce the currencies purposely. All right, but again, if you want to reduce your currency purposely, you have to be very pre-planned and very monitored. All right, as I said, otherwise your currency can your economy can what can collapse overnight. All right, because stock market is too sensitive. And stock market is one of the indicators to understand the movement of country economy. All right, so with the help of stock market, we can also understand this country economy is doing good or bad. And stock market is very, very sensitive. Any good news is go up, bad news go down. All right, so that's the whole idea here. So that's the reason people demand money for speculative purpose. So that's all. So people demand for precautionary purpose, speculative purpose, and transaction purpose. So topic 8 is finished. Now, next topic is the inflation that we will cover in a next lecture. All right. So that's enough for today. So anybody has any question? Any question, yes or no?